Guys, we are super excited today to be back for another round of Inside the Investment. And today our focus is on private debt, specifically in the real estate space. Our guest, as always, is way smarter than I am in the space. We have with us today Neil Shah. He is with a group called Forum. And Neil holds a bachelor degree in mathematics, economics, and finance from Indiana University. He's also global, guys. He got his master in science and finance, or his master of science in finance and economics from the London School of Economics and Political Science. That was a mouthful. It's all good. You can find out more about him on his bio. We'll send a link to his website where you can find that. And I'm going to stop talking and have Neil talk a little bit about himself. Neil, tell us a little bit about your experience in this space of private debt. How you got to Forum. Just give us a little bit of background today.
No, thanks, Adam. And great job with all the word salad of my introduction. I appreciate it. So after I grew up in Indiana, born and raised, and after I went to the schools you mentioned, I started my career at Goldman Sachs in New York, where I traded commercial mortgage-backed securities, almost 14, 15 years ago now, so I'm dating myself, but and that's been a theme of my career from day one, where I've been in the commercial real estate debt space. After Goldman, I worked at a couple different firms. I worked for a firm based in Chicago, where we were structuring commercial real estate debt investments, both private and public. And then almost 5 years ago, or call it 4 years ago, I joined Forum Investment Group, where now I'm a co-portfolio manager on one of our main debt strategies, and I'm also our head of product strategy as well. So have stayed in the commercial real estate debt sector basically my entire career. Has been super interesting and a lot of fun. And thanks for having me. I'm happy to be here.
You're most welcome. And it sounds like you wear a lot of hats at Forum. So again, we're just grateful that within your busy day, you're taking a little bit of time out to speak with our audience today. You mentioned a term that some folks may or may not know, commercial mortgage-backed securities. Sometimes we say CMBS. So this fund invests primarily in those, and then private debt on commercial real estate that your team originates. Is that correct?
That's spot on.
Perfect. And so you mentioned even that history in the past and structuring those. That could be a whole other topic in and of itself, the underwriting in it. It's fascinating. I've talked to Neil, and he can get into the weeds as quickly as you want to. For maybe our audience and listeners who have not invested in this asset class before, can you just share a little bit of insight into the pros and cons of investing in CMBS and private real estate debt as part of their fixed income space?
Yeah, my pleasure. So CMBS is a pretty, it's a niche sector. So I've got a couple notes here. So one of the I would say a pro and a con about the commercial real estate debt space and the CMBS space is that it's smaller than most fixed income sectors. So the CRE debt space, or CRE stands for commercial real estate, so I'll say CRE debt or CMBS. The CRE debt market is about $6 trillion in size, which sounds like a lot, but when you think about that in relation to other fixed income markets, it's actually kind of small. So for example, the US corporate bond market is $11 trillion, and the government bond market is close to $30 trillion. So in terms of fixed income markets, the commercial real estate debt sector is small, which provides an opportunity for specialized niche boutique firms like Forum that have deep expertise in commercial real estate, but it can also make it can be difficult for large institutions that have, several tens of billions of dollars to work to put it to work in the commercial real estate debt space. So it's actually, we view it as a pro in the sense that it's highly specialized, it takes a lot of expertise, and that's a really good fit for a firm like Forum. And we're not investing $20, $30 billion in a fund the way that some of our larger peers might have to. That's one of the key differentiators between the commercial real estate debt space and other fixed income markets. I would also make the point that CMBS is, given its highly specialized nature, it's also much smaller market and it's not typically accessible by retail investors. So you might be able to go buy bonds on Microsoft or Apple, similar to how you can buy individual shares in those companies without the use of a manager. Commercial real estate debt is not that like that. You can't actually, load up your Fidelity or your Schwab account and go buy, $10,000 of a CMBS bond. You have to invest through. The only people that have access to those markets are WIBs or qualified institutional buyers. So it's like the highest standard where it's not available to retail. It's not even available to certain levels of accreditation or accredited investors. It's strictly an institutional product. And even within the institutional world that trades it, there's a handful of investment firms that are well known and are known quantities in the CMBS space. It's still a very relationship driven market. I think that's the third point I would make about, pro or con, was that the commercial real estate debt space on both the private side and the public side is very relationship driven. So you can't go fire up a Bloomberg or a Fidelity terminal and invest in it. You've got to know, different banks and broker dealers that invest in it or that are trading or issuing new CMBS on the CMBS side. And on the private side, it's mostly driven by relationships either with lenders or developers or other kinds of borrowers.
I think that's fascinating. So in a way, there's almost kind of some barriers to entry to this sleeve of the fixed income space that maybe make it a little bit less commoditized than some of the bigger, broader governmental bond issues or like the Magnificent Seven corporate bond issues that you may have mentioned that you might be able to get on a breadth of platforms. So understanding your ability to access this space is limited and you tend to have to work with a partner such as Forum to get in there, I think is an important thing for our listeners to understand. You also mentioned the size and the scale, right? And the size of this particular sleeve of the fixed income world being around 6 trillion in commercial real estate debt versus the 30 trillion in US government debt. That's impressive. Let's talk a little bit about just even the characteristics of this maybe versus some of those others. So for instance, the Forum investment currently yields a little bit over 7%. That's pretty high right now. The high yield corporate bond funds rate, if we use just some generic indexed ETFs as a measure, are trading closer to 6% yields. Can you just talk a little bit about the risk inherent in a portfolio with CMBS and private real estate debt versus that of maybe a high yield bond fund that clients may be more traditionally aware of?
No, you're asking the right questions when you think about our strategy or just the commercial real estate debt fund or commercial real estate debt sector in general compared to, the larger areas of fixed income like high yield credit. One of the key differentiating factors between the commercial real estate debt space and high yield corporates is that most high yield corporate funds have some degree of duration. So duration is a sensitivity to a fixed income instrument to changes in interest rates. And it's called duration because it's closely related to the amount of the maturity of an underlying investment and whether or not it's fixed rate or floating rate. So most high yield bonds are fixed rate and they have terms of 3 to 5 years, which means that they have 3 to 5 years of duration, which is their sensitivity to moves in overall interest rates. Our Forex strategy and a lot of the commercial real estate debt space is floating rate and not fixed rate. So whereas most high yield bond funds have a decent amount of duration where a big part of your return profile is driven by, what I would argue are things out of your control, which is where interest rates are. In a floating rate strategy or a strategy that's mostly focused on floating rate bonds, which ours is, you have much lower duration. So for example, I think most high yield bond funds are between 3 and 5 years of duration. Forex is at 8 months as of the end of last month. And over the last several years, we've kept that duration between 6 and 12 months. So
Wow.
what that means is we've got much less risk to the overall level of interest rates than many of our, like, I wouldn't necessarily call them competitors, but peer funds in the fixed income space. One of the other points I would make, or one of the other risk factors in high yield versus commercial real estate, and this is actually a big reason why institutions have been investing in commercial real estate debt for decades, is the high yield sector has a lot more correlation to broader markets than the commercial real estate debt space. So, for example, the high yield index has a 0.87 correlation coefficient to the S&P 500 on a trailing 3-year basis as of the end of June. Forex has a correlation coefficient of 0.16 to the S&P 500, to the S&P 500 over the last 3 years on the same time frame. So what high yield has done in the recent past has not really diversified you from the stock market. Like, I like to think about, I understand that our strategy it doesn't exist in a vacuum. It exists in a portfolio. And usually fixed income and credit investing is there to diversify you from, riskier holdings like the stock market. Like, the S&P 500 has done incredibly well over the last 5 years, 10 years. And fixed income is there to be, usually it's there to be defensive and less correlated. And most fixed income actually hasn't done that, and that's in the recent past. And so that's one of the highlights that I like to bring up in conversations, which is usually you put credit and fixed income in your portfolio to be defensive. When stocks are down or stocks are up, your bonds should be up and down or should be offsetting. And a correlation coefficient of 0.87 is representative of something that moves close to lockstep to the stock market. And our correlation of 0.16 means that stock or high yield is over 5 times more correlated to the stock market than commercial real estate debt. And so that's another risk factor I would highlight. But the difference between Forex and high yield is, we're operating, our return profile has been that diversifying, the one that most people look to fixed income for. We've actually been able to achieve that in our past 3 years of returns versus many of our fixed income peers, like in high yield. Sorry.
Neil, I was going to say, I think that's a really compelling point for our audience. Those 2 points that you brought up is correlation. And when you're bringing an investment like private debt and private real estate debt into the mix, ideally it's for that. It's this idea of you're bringing in something that moves differently than the other pieces. So listeners, remember what he said, correlation. A correlation of 1 means things move exactly the same and respond the same. So his at a 0.16 to the S&P. And then I think the other side, that duration, we tend to tell clients, think of duration like a seesaw, right? And so when interest rates go up, bond values go down. So the further that duration is out, the further that effect is felt, right? And so that's a really good point. I think we just want the audience to remember correlation, duration. We'll try to throw some definitions in there too, in case you don't know what those are. We'll put them in there. Sorry to interrupt you, Neil. Keep going.
No, I appreciate the clarification. On the a quick point I'll make on the duration point is duration has a place in a portfolio, but we like to tell people that we're not your duration manager. You can go buy, there's probably 1,000 funds out there that invest in treasuries and that get you duration, and we don't want to be that for you. So that's one of the issues I would say with the high yield bonds is you've got a mix of credit risk and duration risk in a high yield fund versus we try to isolate the credit risk in this vehicle and avoid giving you duration risk. You should go, duration belongs in a portfolio, in most portfolios, and there are much better ways to get access to that. And we don't want to, muddy up our return profile by having lots of duration. So it's a deliberate, portfolio construction objective of ours is to not have too much duration, because we know that our clients and our investors can go get duration somewhere else.
And no, I think that's you mentioned in that response even the idea of you could seek interest rate risk or credit risk. Tell me a little bit about that, right? So when it comes to the credit risk side of stuff, how does credit risk affect the way that you manage the CMBS and the private real estate side of things?
No, that's so we are focused on taking credit risk and getting paid and generating returns for taking credit risk. Part of why our fund has lower correlation to broader markets is because of what we're investing in. And so we're investing in single asset, single borrower CMBS holdings, as well as private credit commercial real estate debt holdings. So that single asset, single borrower space is nicknamed, or it's called SASB. So even within the CMBS subspace of fixed income, there are two major different types of CMBS that aren't guaranteed by the agencies. There's conduit CMBS and there's SASB CMBS. Conduit CMBS is also, people call it pooled, where you've got maybe 50 to 70 loans that are all unrelated, that all go into a pool and get securitized. We aren't very big on investing in conduit CMBS because it's hard to do deep underlying credit work on 50 different loans. There are investors who do it. It's not really, it's a much higher yielding space. There's a lot of hedge funds and private equity firms that do that, that do some of the higher risk conduit investing. We like to focus in the SASB space, which has grown significantly in the last 5 to 7 years, where instead of having a pool of 50 loans that gets you to like $1 billion of a deal size, there's just $1 billion loan in an entire deal. That's a SASB deal where we can underwrite the underlying properties or collateral. It's either from a single borrower, like Blackstone, for example, is a big user of the SASB CMBS market to finance a lot of their real estate holdings. Blackstone will issue, they'll say, I've got these three industrial properties that I'm going to securitize. I'm going to borrow against those properties in a CMBS deal. I'm just going to take one loan out that's $1 billion loan that's backed by three properties, and then an investment bank will securitize that loan by itself. It's too big to go into a conduit deal, and it actually is a really good fit for investors like us who are real estate experts, and we can put meaningful amounts of money to work and also have a very strong view and have done deep analysis on just a single property or single portfolio of properties.
Dude, that's great, and ties into that relationship idea and going, Adam Keller does not have the audience to go to Blackstone and find out these deals that they're doing. But with those relationships, not only could you find the deal flow, but you also have the underwriting team and the ability to go in and break apart those components underlying that single loan to decide whether or not the juice is worth the squeeze, right? And the amount of risk you're taking on for the yield that you're getting, et cetera.
That's 100% right. To be able to access the CMBS space, it requires both expertise and familiarity with the capital markets and relationships with mostly big broker dealers, but you also have to have the ability to do meaningful credit work and underwriting. So that's part of why it is a difficult to access space, and that's part of why the government doesn't allow retail investors to invest in CMBS, because it has a lot of moving pieces, and not only do you have to know a lot of the intricacies of how CMBS is structured, but you also have to be able to underwrite and understand credit risk. And so, and these are not, it's a lot different than underwriting, like shares of Apple or Microsoft, which have a lot of publicly available information. That's another difficult part of the commercial real estate space, is that most of the information that you would need to underwrite these and to actually do your homework and make an educated investment decision, it's not publicly available. So the banks give that information out selectively to investors like us, but it's not available, through like the SEC website, for example.
I think that's a great point, and we maybe even just breeze by the fact that it is private real estate for a reason. To your point, not all of the metrics are publicly disclosed nor are required to be, and so you have to have access to that information channel and the expertise to make that information useful. Thanks for clarifying that. Guys, Neil's also been good about giving us some deeper nuggets. We'll have to do a second call in the future and ask him about the different tranches in that one single loan. Tranche is just a fun word to say. We won't bog him down on that today, but maybe that's a teaser for another time to come back and listen again. Neil, you shared a good amount in the space already. We can talk a little bit about your asset class, CMBS, private real estate, in the current economic environment. What excites you right now? What scares you in your space?
So we're really excited about what's to come in the commercial real estate space. We only see growth and more users of both the CMBS market as well as the private commercial real estate debt space. So with a lot of large lenders like insurance companies, or especially banks and regional banks, they compete with those lending, they compete with those markets that we participate in. They have pulled back for different reasons. So we're seeing a lot of opportunities and deal flow where we wouldn't necessarily see them before because other lenders are pulling back. So that makes like a strategy like Forex really well positioned because we've got the ability to do both private and public CMBS investing. I'll talk a little bit about the private side. We've got a team in-house called our structured finance team. I sit next to them. We talk every day. We're working very closely together to originate deals that are a good fit for Forex. And that team gets a lot of inbound calls from both senior lenders like banks who need another piece of debt on a property, for example, where we can come in because we're experts and because we have the specialized skill set. We can provide like a mezzanine loan or a preferred equity piece that is beneath a bank's senior loan. We do a decent amount of that, especially backed by multifamily properties, since Forum is a multifamily developer, owner, and operator. So we can use our expertise to make those kinds of loans on apartment buildings. We also have lots of relationships direct to borrowers. So much of what we like to do in our space is repeat business. Like I talked about before, it's a largely relationship-driven business. So when we do a deal with a borrower, for example, let's say they're building an apartment building or student housing project, for example, in Florida, we actually did a podcast that we can talk about, where we talked about one of the student housing investments that we financed in Florida. That was a borrower and a developer that we've done more than 4 deals with. So we like to partner up with people where it's a mutually beneficial relationship, where we're not just looking for one deal. We've got a lot of money to put to work. The fund has seen a lot of growth, which is really exciting for us. And that means we like to work closely with sponsors or borrowers that have multiple deals in their own pipeline too. So that's a big part of how we do business on the private side and how the structured finance team sources deals. Mostly it's from people we've already done business with. And that's a big part of our underwriting and how we get comfortable with the sponsor is, we've done 2 or 3 deals with them. We've gone, full circle or round trip where we lent them money, it matured, they paid us off. So that's another big factor, or a little bit of a window into how we underwrite and source and invest in the private side of the space.
I think that's great. And that underlies the point you made earlier about it being relational. I think one of the terms we think of from previous days of diligence in the non-traded and private investment space is this idea of surety to close, and understanding that when you're doing business with people and they enter into a deal, they're going to bring it to fruition. I think about this idea of the repeat business like you're talking about. This isn't a super arm's length transactional deal where I can trade 50,000 shares of a 30-year treasury. To your point, you're developing a relationship in the process. And by doing the right thing, you're able to kind of come back to the well multiple times. I think for folks that get a little bit disillusioned with maybe the heartless nature of investing as a whole when it comes to the commoditized side, it's nice to know that these kind of relationships still matter. Doing the right things still matter. It doesn't mean that deals can't go wrong and risks aren't there, but that's cool. I think that's nice for folks to hear that aren't doing it every day.
No, I like that you brought up selling a big block of treasuries or stocks, because that's actually one of the reasons why our returns are not correlated. We also have lower volatility too than a lot of high yield funds and the stock market. And it's driven by exactly what you just pointed out, where if a borrower needs, a mezzanine loan, for example, on their third project, they could go, try to hire a broker and get a bunch of quotes. And, if we were going to lend them at a 12% interest rate, for example, maybe someone else out there would do it at 11.75, but that's not how this business operates. And that is how the stock market or the high yield bond market works. It's about every penny and every last basis point. In our market, because it's relational and it's very much driven by trust and the relationship between the lender and the borrower. Borrowers they oftentimes aren't trying to squeeze out every last basis point of an interest rate, because they need surety to close, like you talked about. They also need cooperation from their lender too. Sometimes, if they need an extra month to make an interest payment, or if their construction is delayed, if it's a construction deal, they want to be sure that their lender is someone that can work with them and that understands their business. And if you're looking for just the lowest cost provider, you might not have those other softer or intangible aspects in that business deal. And whereas if you're buying and selling stocks or bonds, like you pointed out, every last penny counts. In our business, it's not about every last penny sometimes. It's about, I trust you. You gave me an accommodation on the last deal. I know that you're a good partner. So, and as long as the terms are fair and on market, you usually see people choosing to do repeat business and not saying, well, you know what, maybe someone will give me 11.9% instead of 12. So let me go talk to 10 other lenders. That's not really how this business works.
I think that's great. We appreciate that. Neil, you've been gracious with your time. We've probably gone even over what you've allocated to us, so we appreciate you sticking with us. The conversation was compelling, right? Otherwise, you wouldn't be here. We hope for our audience that this exposed you a little bit more to the concept and idea of utilizing CMBS and private real estate debt in your portfolio, or at least piqued your interest enough to where you'll go ask some more questions on it. Neil, thanks again for your time. If there's anything you want to close with, have at it. Otherwise, we appreciate it, and we're going to send you back to do the work that you do.
No, thanks a lot, Adam. This is fun.